Welcome back. This is chapter 3, video 7, and the topic is prepare closing entries and a post-closing trial balance. So let's go ahead and let me share my screen. Okay, prepare closing entries and a post-closing trial balance. We're assuming that we have finished preparing our financial statements at the end of the period, and we now need to get ready for the new period. When we do that, we have to make closing entries, and we have to close out what we call temporary accounts. They would be all our revenue accounts, expense accounts, and dividends. You can remember the temporary accounts by the slogan RED. R for revenues, E for expenses, and D for dividends. And the basic theory is this. Let's say that we're in January. It's January 31. We just finished preparing our financial statements, and we want to go to February 1, the next period. Well, we don't want January revenues in February. So what we do is we close them out to retained earnings. And so when we move the revenue account to February 1, the new period, it will be 0 and we start over. Likewise, we don't want January expenses in February. So we close them out to retain earnings in January, at the end of January. And then in the next period, February 1, we have all the expenses will have a 0 balance. We do the same thing with dividends. The only thing we'll have left that moves over to our new period in February would be our permanent accounts. And those are balance sheet accounts, the assets, the liabilities, and the stockholders' equity account, which would be common stock and retained earnings. So let me offer you this slide here. I even say to write it down. What we're going to do is, record information during a specific accounting period, and we're going to capture all the revenues for the period, all the expenses for that period, and the dividends for that period. It could be for a month, it could be for a year, whatever your period is. But when we're done with them, we want to close them out to retained earnings. So let's say that we've finished our financial statements for the year ended December 31, 2021. Well, we don't want 2021 revenues in 2022, right? So we close them out. We don't want 2021 expenses in 2022, so we close them out. And we do the same thing for dividends. And when we close them out, we close them to retained earnings. So then in 2022, all our revenues will have 0 balances. All of our expenses will have 0 balances, and dividends will be 0, right? Because we're starting over a new period. And what's left? Let me write this down. Your balance sheet accounts, which are the permanent accounts. Assets equals liabilities, and the equity is made up of common stock and retained earnings. So after closing, only balance sheet accounts are carried forward. The ending cash balance of, let's say, 12/31/21, December 31, 2021, becomes the beginning cash balance of January 1, 2022, right? Now that makes kind of sense. Let's say that on December 31, you have a cash balance of 10,000. Well, the next day, at the beginning of January 1, don't you still have that cash in your bank account? You'd be very surprised if it says zero because you're in a new period. Well, assets move forward. Likewise, let's say that you owed somebody money on December 31, right? Let's say you owe $20,000. So on December 31, now it moves to January 1, and you say to your creditor, well, I'm sorry, it's January 1. It's a new period, so I don't owe you anymore. No, it doesn't work that way, right? So your assets and liabilities, they all move forward along with the equity accounts, common stock, and retained earnings. Now, these closing entries transfer our net income and dividends into retained earnings. Remember, net income is revenues and expenses. You net that, that's net income. That goes into retained earnings. And also, your dividends are going to go into retained earnings, right? And there's a procedure for that. And this is how it is. What you're going to do is you're going to close your revenues first into income summary. Then you're going to close all your expenses into income summary. So now all your revenues and expenses will be zero, and they're all in income summary. Now, the net of revenues and expenses is net income. So basically, in income summary, it holds the net income. Then we're going to transfer that net income into retained earnings. And finally, we're going to transfer the dividends into retained earnings. And that's how it works. And you're thinking, man, that's pretty intense. Well, let me tell you a way to really remember this. Remember the slogan, READ, R-E-I-D. So R stands for close revenues. So remember, revenue has a credit balance. So how do you get rid of the revenue? By debiting it. And where do you put it? In the income summary. E, close expenses. Well, expenses have a debit balance. So how do you get rid of them? Close them out by crediting the expenses. And where do you put them? In the income summary. Now, right now, what's sitting in income summary is your revenues and expenses, which is net income. And what we're going to do is we're going to close that net income that's in the income summary into retained earnings. That's where we get the I, close income summary. And so net income will have a credit balance in income summary, right? If it was a net loss, it would be a debit, but we know that in net income, revenues exceeds expenses. So when you have net income, that would be on the credit side because revenues win and revenues are on the credit side. Well, how do you get rid of a credit in income summary? By debiting it. And where do we put it? Into retained earnings. And finally, we close dividends, right? D, close dividends. Now we know that dividends is part of aid and it has a debit balance. Well, how do you close a debit balance? Well, with a credit. So you get rid of it, you close out the dividends, you get rid of it, and you put it into retained earnings. And you're done. Let's show you how this works with the an adjusted trial balance. So these are the numbers that we use for our financial statements, okay? The adjusted trial balance is what we use for our financial statements. But now it's December 31, where we need to get rid of our temporary accounts. It's because we want to prepare for the new period in January. So how do we do that? We use READ and do our closing entries. Number one is R, close revenues. And if you look up here, we have a credit balance of $79,000 for our revenue account. Well, how do you get rid of a credit balance? Well, with a debit. So that's what we do. We take it out of the revenue account, and that makes it 0. And we put that revenue into income summary. And you can see we're going to run a little T account here. So right now we've closed out our revenues, and what was in revenues is now in income summary. The next one we're going to do is E, which is close expenses. Now you see that expenses, looks like there's only 2 of them, right? Salaries expense and office supplies expense. Those are debit balances, right? Well, how do you get rid of a debit balance? Well, with the credit. So that's what we're going to do. We're going to credit all of our expenses to take them out. And where do we put them? Into income summary. Now, when we put our revenues in income summary and our expenses into income summary, we have net income here, right? Our revenues are 79,000. Our expenses are 64,000. The net of that is a credit balance of $15,000, which represents net income. So we need to transfer this net income into retained earnings. That's where we come up with I, close income summary, right? So we're going to close it out, and it's a credit balance, so we're going to debit it, right? We're going to debit income summary for $15,000, and where do we put it? Into retained earnings. So notice here that we successfully closed out income summary, and now our net income sits where it's supposed to in retained earnings. Last one, and this is the easy one, is D, close dividends. Okay, well, if you see here, dividends is a debit balance. Well, how do you close a debit balance? With the credit. So let's do it. We close out the dividends with the credit, and we put it into retained earnings. Okay, now isn't this kind of interesting? We have the makings of a retained earnings statement here. Beginning retained earnings of 45,000 plus net income minus dividends of 20,000 is our ending retained earnings balance of 40,000. Check this out. See how we did that? So when we netted all of the or transferred all of the temporary accounts into retained earnings, we can calculate what our ending retained earnings balance is, and we put that right into the balance sheet, right? Right in the balance sheet where it goes. All right. Let's go ahead and complete quick study 3-20 on page 121. So I'm going to end the show here, and I'm going to do this here. All right, so I have the answers here, but I'm going to explain it. So I'm going to look on page 121 and do quick study 3-20. That's the the first one up there. Okay, notice that we're going to be looking for R, revenues, E, expenses, then I, income summary, and D, dividends. Okay, so first off, we're going to close revenues. So what's our revenues? Well, our service revenue is 13,000, and you have to know that revenue is a credit balance. So how do you get rid of a credit balance? Well, you debit it. You take it out with a debit balance. And where do you put it? In the income summary. Next, we do E, right? Close expenses. Now looks like we've got 2 expenses, wage expense of 8,400 and rent expense of 1,600. Okay, well, how do we get rid of expense? We have to know that expenses are debits, right? Expense is part of aid, and it's a debit. Well, how do we get rid of a debit balance? By crediting. So what we're going to do is we're going to list all of our expenses, and we're going to credit all of them. And then what we'll do at the last is add up all of our expenses and figure out how much we're going to transfer to income summary. That's why I have a little box here, because you don't even know what this is. What you need to do is you need to list all your expenses, add them up, all the credits up, and then the offset will be to the debit to income summary. And that's why I did that. Now, what do we have in income summary? Well, we've got our revenues of 13,000, and we also have expenses of 10,000. So what's sitting in income summary is net income of 3,000. Now notice here that the revenues are 13,000 and expenses are 10,000. The revenues win, and that's why it's net income, and it's a credit balance. Well, how do we get rid of a credit balance? Well, debit. So we're going to take the net income out of income summary with the debit, and then credit the retained earnings. So that's it. Debit income summary 3,000, credit retained earnings 3,000. The last one is really easy. It's dividends, and if you see there, dividends are $800. You have to know in this problem that dividends is a debit balance. How do you get rid of a debit balance? With a credit. So we're going to credit the dividends 800 and transfer it into retained earnings. So the answer here for D would be retained earnings debit 800, credit dividends by 800. Okay, perfect. All right, now I'm going to explain what a post-closing trial balance is, okay? This is a post-closing trial balance. And just like any trial balance, it proves that debits equal credits, right? But notice here that it only includes permanent accounts. It includes assets, liabilities, and the equity. What you will not see on a post-closing trial balance are the temporary accounts. You will not see revenues. You will not see expenses. You will not see dividends. Why? Because you close them out to retain earnings. Now, if you have a trial balance that has revenues or expenses or dividends, it's not really a post-closing trial balance because you can't have any of those. Matter of fact, on the test, you're going to have one of these questions. It's like when you're back in like preschool, like Dora the Explorer or something. Just which one of these don't belong? Yeah, it's going to be like which one of these don't belong on a post-closing trial balance. And you're going to be looking for revenues, expenses, and dividends, red, because the temporary accounts are not on a post-closing trial balance, okay? All temporary accounts will have zero balances and will not appear on the post-closing trial balance. Now, after we prepare our post-closing trial balance, those are the numbers that we're going to use at the beginning of the new period. And we do the same thing that we've been doing over again. So this is what we call the accounting cycle. And after this chapter, you have completed what we call the accounting cycle. And this happens every period. You start out with analyzing your transactions, like we did in chapter 1. We journalize, like we do in chapter 2, and then we post to the ledger, right? Now, that's in chapter 2 as well. Then we're going to prepare our unadjusted trial balance. And where do I get these numbers for the trial balance? Well, they're the ending balances from the general ledger. Okay, so we look at them and they're not up to date, right? You got to look at them and make sure that they're up to date. Like, hey, we didn't recognize that we use supplies. Hey, we didn't recognize that some of our insurance policy expired. So we have to make all these adjusting journal entries. And that's number 5 here. Adjust and post the adjusting journal entries, right? Then once we've created the journal entries and we posted them, then we're going to take the ending balances from our journal ledger again and prepare an adjusted trial balance. Though that adjusted trial balance are the numbers that we're going to use to prepare our financial statements. Okay. And that's the end result of at the end of the period. That's why we do this, is for these financial reports. Now, when we're done preparing the financial statements, we need to start preparing for the next period. So what are we going to do? We are going to prepare our closing entries, which will close all of our temporary accounts. We'll close revenues, close expenses, and close dividends. And when we do that, we can run our post-closing trial balance. And these are the numbers that we're going to use at the beginning of the next period. And at the beginning of the next period, we do the same process again. That's what we call the accounting cycle. Okay, I'm going to stop the share. All right, that is it for this lecture. So we'll see you in the next video. Happy studying. Bye-bye.